Got it. All right. Thank you. Today's presentation will be called Myths, Maths, and Methods of Trading. It's a big picture view of the techniques of what is important in trading, really important in trading. So what we will be talking about is how to improve your trading results using 5 techniques. Although they are literally techniques, I would like to say they are more like principles. And using these principles, I can considerably improve their trading results. This is geared towards private investors. It's especially newcomers to the game, to save them the issues that the problems that we'll find later on. So okay, let's begin. Myths, maths, and methods of trading. Risk warning, as usual. There is a very high degree of risk involved in trading, and past results are not indicative of returns. We're making certainly no guarantee that you will be profitable following any techniques of this presentation, but I can give you another guarantee that you will have losses in trading. And with that, for bonuses for those that manage to stay awake up until the end of the presentation. In 2022, I submitted a paper called MACD Volatility Normalized Momentum. It is a research I did in 2014, actually. I submitted in 2022 on how to improve the MACD indicator, and so we can overcome the 5 limitations it has. Now, that piece of research I submitted it to 2 professional bodies, the National Association of Active Investment Managers, and also the Chartered Market Technicians Association, which is the largest technical analysis association globally. And I managed to win 2 awards. For the first one is the Founders Award from the National Association of Active Investment Managers, and also the Charles Dow Award from the CMT Association. No, so for those that managed to stay with the presentation, I will send them the details of how can they get the paper. Also, the MACD has been embraced by the community, and it's now in TradingView, Stock Charts, MetaStock, MT4, Optima. Very soon we will be there. So, and also I'm doing some more advanced webinars on the MACD. So if anyone is interested to get all these, feel free to send me. These are your attendance bonuses for the webinar. So feel free to send me an email at alex@alexspiroglu.com. So without further ado, okay, let's see the myths of trading. Yeah? Again, we're talking about this webinar being about newcomers to the game. So let's do a quiz. Would you prefer a strategy that wins 70% of the time, wins 30% of the time, or I'm not sure which one to choose, which one is the correct? Feel free to write at the chat box which is the correct and which is your preferable answer, to win 70%, to win 30%, or you're not sure which one to choose, which one is right. Okay, write it down and also note it on a piece of paper. Second quiz. Would you prefer a strategy that has a reward to risk of 2 to 1, a reward to risk of 1 to 2, or I'm not sure which one to choose? Again, a reward to risk 2 to 1, reward to risk 1 to 2, or you're not sure which one to choose. Okay, here are the answers. You think as a trader, not as a chartist, if you chose answer 3 in both times. So that is the correct answer, answer 3. We don't have enough information based on the questions. I'm sure most people would be tempted to say the 70% and also the 2 to 1, but this is incorrect, and I'll show you why. Let's go into the maths of trading, and then we'll see the answer. First of all, that is the first myth, that you have to have a high winning percent to have a profitable strategy. Winning percent basing is the number of winners to number of losers. So for example, if you take 100 trades, If you win in 60% of them, you have a 60% win ratio. Second myth is they have a high win-loss ratio. Basically, what is your average winning trade versus your average losing trade? So for an average, I would like to be winning 100 pounds or dollars or whatever currency denomination, or losing 10. So it's better to have a 10 than 100. But both of these, I consider these very popular myths. The reason is because the expectancy formula, how much you expect to be making on average per trade, is the winning percentage, how many times you win when you win. What's the average winning trade, how much you win when you do win. So if you win 60% of the times and you win 100 pounds, minus the 40%, which obviously is the losing percent, times a theoretical example, let's say 30 pounds per trade. So that's how much you would be expecting to win on average. So but you can see a lot of combinations. So for example, you can see a high win rate, a very high win rate. So for example, this particular scenario, you win 95% of the times, but you win $40. You lose 5% of the times, and you lose $1,000 on average. So on a net basis, you lose $12 each time you trade. So even with a very high win rate, that's a losing strategy. Let's see a very high win rate. So okay, 80% of the times you win, you make $700 per trade, and then you lose 20% of the times and lose $1,000 per trade. Now, so although you have a lower win rate, you're still making some money. So say with a moderate high rate, so which is 55% of the time winning with $1,600 and 45% losing with $700, you make $565. So although you're decreasing your win rate, you're making more money. And that is because when you do make money, you make a lot more than you win. Than you lose. And a very low win rate, again, same thing. So it's not really about, it's not really about how often you win, but also you should be seeing it in comparison to how much you win when you win. So theoretically, we can build this curve at the break-even line, which shows you what are the possible combinations of a winning percentage and the win-loss ratio. So for example, anything that is above the break-even line, at the break-even line, basically as the name implies, you have a zero-sum strategy. If you're above it, strategies are profitable. If you're below it, they're unprofitable. But as you can see, you can have a winning percentage, say around 10%, which is at the bottom left part of the corner. But if you win 9 times as much as you lose when you do win, then you're still profitable. And you can go to the bottom right part of the screen. You can see you can have a winning percentage up to 95%. But if your win-loss ratio is not big enough, you can still have a losing strategy. So the break-even line shows that there are a lot of ways to play this game, both with high and low winning percentages, but it's their combination that matters, not each statistic individually. So let's see the components. So basically, whenever we trade, there are 4 combinations. There are only 4 things that can happen, or no matter what strategy we do. We can win big, we can lose big, or we can win small and then you can lose small. That's pretty much it. I mean, there are 4 results we can have whenever we open and close a trade. So what is the definition of big and small? What's a big loss and what is a small loss? So let's put it in terms of R multiples. The late Van Tharp first mentioned this. So if we, for example, risk, say 1 unit of risk, it can be, for example, say £1,000. If we make more than, if we make 2 or 3 times that, that's a big win. So for example, for every dollar or pound we risk, if we make 2 or 3 times that, that's a big win. If we make less than that, we can call it a small win. Now, the same thing can be applied to losses. So if, for example, say, okay, we lose, we bet $1,000 or 1,000 pounds. But for some reason, because, for example, the market gaps against us and we don't get stopped out at the price we initially wanted, or because we cancel our stop loss, for example, we end up losing more than we initially had budgeted for. That's a big loss. And if that comes down to 2 or 3, so these are the combinations you can have. So that's how your definition of a small win and small loss, big win, big loss. So if you plot it like this, so 1 R is a small win, 2 R's, 3 R's, with green, it's the small, so the big wins and the small losses. So let's look at the frequency. So this is what happens with profitable traders and what happens with losing and break-even traders. So profitable traders, their P&L, the results, if you will, are skewed to the right. So they obviously they win more often. They have they're skewed to the right in terms of how many big winning trades they have. Losing trades is to the left, and break-even is obviously to the middle of the distribution. So what is our trading goals? Our trading goals, I would say there are 4. First of all, as much as we can try to increase our win percentage. That means that, obviously, since it's a mutually exclusive event, our winning, our losing percent of losing trades will decrease. Our second goal, and I think this is the most really important one, is to eliminate big losses. That's the most important goal we have. The third one is to increase our large wins. Basically try to push the trades as much as we can. The fourth one is to have the small losses and small wins basically offset with each other. So our goal is, when we have big wins, eliminate the big losses. So we'll be left with small wins and small losses, which will be offsetting each other. On a net basis, we'll have the big wins to provide the results for our portfolio. So again, I'll be making some basic concepts, talking about what is a drawdown. So the drawdown basically, if you've got your account reaches the maximum of say $10,000 or pounds, and it goes down to 7, that's a 30% drawdown. And then when it goes, so for example, it goes back up to 12,000 and then comes back to 6,000, that's a 50% drawdown, maximum drawdown. So just to make sure we are on the same definition in terms of when it's a drawdown. So let's go into now that we covered the myths and the maths of trading, let's go to the methods, which will be the most practical. So how can we achieve these goals? So first of all, our first goal is losing big. We must try to avoid that, cut our large losses basically, and we can do it with 3 ways: stop risk management at the trade level, and also portfolio risk management. So because now our second goal is to win small, and we can achieve that by the principle of trading with a trend. So because we increase the chances of a winning trade. So how can we win big? In order to win big, I think we must let profits run, and in order to let profits run, we can use, of course, a trailing stop, but also make sure that there is an underlying macro trend, because yes, you will be trying to catch a large move, but in order to catch a large move, there has to be some kind of reason behind it. So we must align ourselves with that reason. That reason is always macro, it's never technical. And in order to have longevity overall as a trader, we must not put, try not to put our eggs in a basket, have diversification, which can be over time frame diversification. So we can have diversification over, in three ways. Either we can have the system or the method applied across different time frames. We can have across different markets, or we can have system diversification, which I think is the best one in terms of having uncorrelated strategies. So let's look at this in an example. Okay, try to eliminate our large losses, cut your losses. How can we do that? Again, the same graph we saw before with the distribution of R's, R multiples. So as you can see, the 3R, which is involved, this is what we're trying to eliminate. This is the most important, but also it's the easiest part. So how can we eliminate large losses? It's the most important thing you can do, the first thing you can do as a trader. So as I mentioned before, there are three reasons why big losses happens. One, if people don't use a stop loss, or they use, of course, and they cancel it. Second is because if they have a large position size, basically traders management, that means if they have a very, very big position. And the third one is they do have a stop loss, they do have a large, a normal position size, but the positions they have are very correlated. So for example, if someone says, okay, I'll be trading, say, a very simple position sizing technique, say 0.5, 1% of my portfolio in one trade. And I'm long DAX. Then I'm also long FTSE, long S&P, long Russell, long S&P 500. So basically you have one huge position, equity exposure position. So it's basically it's the same, it's the same thing. You have the same trader, so to speak. Or if you're going to be trading, say for example, currencies, but let's say, okay, I'm long euro versus the dollar, long Canadian dollar versus the dollar, long Australian dollar versus the dollar. But yeah, okay, you have one big, huge, short US dollar position. And of course, they may not be correlated, completely, but the exposure you have is pretty much based on the same thing. So position correlation is also something that you must really be wary of. So basic stop loss. Right, we must learn to love our small losses. That's the most thing. And as Pat Arbor said, chairman of the Chicago Board of Trade, the trouble with the loss is not only a loss of money, but also a loss of ego. So once we learn how to love our losses, then I think that's the first step. Learn to love our small losses. So how can we do that? Why is it important? Because the more we lose, the more difficult it is to recover from that, and it's not symmetrical. So for example, if we lose 5%, we need 5.3 to recover. If we lose 10%, we don't need 10 to recover. We need 11.1. So if we lose 20%, we need 25 to recover. And I think past this point, past the 20 to 25% is the point of no return. I mean, you are in control. You are at the controls, but you're not in control. Psychologically, it's very difficult for someone to recover after a 25% loss. I'm not saying that it's impossible, but psychologically, that will have a big effect on us, and it makes people take decisions that they should have. It puts a lot of pressure on them. So I think 20 to 25% is the max draw that anyone should have. Obviously, more people, depending of course on their profile, for example, institutionals try to have anything from 10 to 15% drawdowns. But again, as private investors, usually after 25%, it becomes very difficult to recover, at least psychologically. So what is a basic technique we can use as a stop loss? There are many. It's not, I won't be going through all of them, but we can use just a very simple method, just an average true range. I'm not saying it's the best, but it's a start. It's definitely a start, and it's easy to calculate. So what is the average true range? Again, it's very easy to calculate this, and there are a lot of information out on the internet and books about it. I'll just give you a brief description. Average true range is a technique that was discovered by Wallace Wilder. Wallace was a futures guy, and he basically wanted to account for gaps. So true range is so if there is a gap between two bars, and gap being for example, if a market has a low that is higher than the previous bar's high, or it has a high that is lower than the previous, there is low and leaves a gap. So that's a way to calculate the true range of the bar. I think I did my previous webinar was on volatility, and I explained a lot about the average true range and the techniques we use it. So if someone looks it up on the FX Street website, they can find more information about it. So so this is the chart of, for example, the top of the S&P 500. On the middle panel, I have the average true range. And as you can see, volatility, is volatile. It fluctuates. It gives a number. It's an absolute number. And with that, what you can use is take this number, which calculates basically the average fluctuation. So, for example, if you want to be seeing for the past 14 days, you can see how much it fluctuated in absolute points, ticks, pips. And you can say, okay, whatever the fluctuation is, so for example, 13 points or 100 points or 25 points or ticks, depending on the underlying market, because it's an absolute price indicator. What I will do is I will multiply this, because that's the average. I mean, that's how much the market fluctuates anyway. So I want to be having my stop a bit outside of that. So what you do is you can take, say, for example, 2 times that or 1.5 times that, and deduct it from your entry. So here is an example. So let's say we try to enter where the green arrow is. I won't examine why we enter there. Let's, for example, say we enter there, and we multiply the average true range, I mean the average fluctuation, and say we'll put a stop 2 times below that. Obviously, we put it 2 times below. It's a long trade, or above it's a short trade. This is pretty classic. So we put it at the distance. So if there is any fluctuation, we won't get stopped out. So this is a very, very simple basic technique, but it's very important. So for example, if you, let's put the some numbers on this. So if it's the average range 25 pips, I'm sorry about that. Obviously, if we put a stop which is twice as big, we'll put it at 50 pips. And if we put it 3 times that should be 75 ticks. So no, the problem is that the further away you put it, it will impact your position size, because you have to adjust your position size as well. We can't be trading the same amount of contracts for the, if we put in the, so there's a trade-off. Yeah, you will be getting stopped out less often, but we will be having smaller position size. So again, but the simple methods how we can use our chart. So which is the second way to eliminate losses? This is what they call the risk hierarchy pyramid. So let's say, for example, we're trading a small account, like say 50,000 pounds. So we can eliminate losses, our risk management, for example, at the trade level. So let's say we'll be trading 1% of capital for one trade, which is basically 500 pounds. This is how much we will be risking. And so if we said, if we say we'll be risking 1 or 2% of our capital, say for example, if it is say, and we do a 2 ATR, so 2%, okay. For this example, it's like 100K, our account, 2% of that's 2K. So with using a twice APR, we basically risk, doing the math, 40 pounds per pip. So if we do 2% of our account, that's 2K. So using the 75 ticks, which is the average, 3 times the average range, we'll be risking 25 sterlings per tick. So so you can see there is a trade-off between the distance and how much we will be taking as a position, given that the amount of risk we'll be having in terms of how much we'll be losing, say 1% or 2% per trade, it remains constant. So this is the second way. So the hidden risk is correlations. Again, this is a basic correlation table of all the various instruments, and it is something that we should be checking. before when we take on our trade and see what is the correlation between our positions. And because we don't want to be having highly correlated positions with each other. So it's always good to be checking this. As we mentioned before, especially when it comes to taking positions within the same asset class, it is very important to be not taking risk that we shouldn't be, in the sense of having too much of this position exposure in the same asset class. So we talked about the risk and hierarchy pyramid, okay, 50 grand, we talk about, then we have the portfolio risk. So for example, how much we will be putting in our portfolio, how much we will be totally risking for before we call it quits. 50% of your capital, 30% of your capital, 20% of your capital. So basically when you have an account, say 50 grand, and say, okay, this is how much I'm willing to lose in total before closing my account. I don't think it is a valid strategy to say I'll wipe the whole of my portfolio, but if so, but it is very important to be having an initial number of how much you will be willing to lose before you start trading. Because a problem I see very often with individual retail investors is that they don't have a portfolio risk level, which means a number when they will just stop trading afterwards. So that's why they wipe their accounts out. So if you say, okay, I'm willing to lose 25,000 pounds, so 50% of my capital, then at the 25 grand, I'm closing my account, but they usually go way above that. So we also have a strategy risk, and that means that, okay, we use one particular strategy or two different strategies. I tell you, we usually have a portfolio of strategies. How much we will be willing to risk or invest, if you want to use a different term, in one particular strategy. And the reason is that no strategy lives forever. So if you have, for example, using a mean reversion or a pullback strategy or a breakout strategy, how much are you willing to, what's your budget for, how much will you be investing in that one? Because if it starts losing, then you want to be switching to something else. The second is sector risk, as we mentioned, using the same asset class or the same sectors, and then also trade risk. So there are different layers of risk management. So that was the first goal achieved, how to eliminate large losses. So this is the way of eliminating large losses. As we mentioned, as a recap, have a stop, don't have a large position size, and watch your correlations. So what's the second goal we mentioned? How to increase the winning percentage. The easiest way to do this is align ourselves with the trend. That's the easiest way. So to achieve the second goal, the trend is your friend. So again, this is a chart. My good friend Mr. Hirsch from the Stock Traders Almanac. So this is the growth of 100 grand. Again, this is a hypothetical example in the S&P 500 investment by missing the worst days. And what this goes to show you is, for example, if you invested in from 1994 to 2014, and you cherry picked what are the worst days, for example, days that you lost, like the market fell 5%, 6%, 3%, 7%, and you took this out, how much would this affect the total value of your portfolio? Obviously, this is hindsight. So if you invested fully during this era, you would get the 100,000 would be 3,400 $340,000. That's the old days. If we've missed the worst 50 days, that would have gone to 5 million. Now, obviously, as I mentioned, this is hindsight, because we don't know when a big losing day, a big large day to the downside will come. But it goes to show you the importance of it. But can we actually have a strategy that helps us with this? Let's look at it in more example. So again, this is a chart of the S&P 500, and this is a plot of the 200-day simple day moving average. So as we talked about the worst 30 days, if we try to see where these 30 days occur, we'll find that 24% are happened below the 200-day moving average. If we try to look where the 100 biggest losing days happened, you'll find that 83 of them happened below the 200-day moving average, which means that as long as you're following the trend, that by and large, most of our days will be up days, not down days. And that's why the adage is the trend is our friend. It goes to show you on a numerical basis where the trend is our friend. Again, here's a chart of, here are some numbers. If we buy the S&P 500, again, buy and hold is 9% return, the drawdown will be 55%. But if we filter this with the 200-day moving average, we get long whenever we are above the 200-day moving average at 6.27. Obviously, it's less, but we have half the max drawdown. This is not a systematic, it's a full strategy in the sense of, to trade simply moving average crossover. But it goes to show you that when you are aligned with the trend, you risk you lessen your drawdown, which is very, 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 very important. So, and again, I'll show you another technique, another thing how you can do that. You can use the very popular RSI, and this is not something that many people know about the RSI. For example, there is a relationship between the RSI and the moving averages. And this is how you can use it as a trend tool as well. So when the RSI X, and X I mean whatever look back period you're using, and that crosses the 50 line, which is the middle line, then price trend to cross the double that exponential moving average. Which means when you've got an RSI, say with the default look back periods, which is 14, when that RSI 14 crosses the 50 line, then it's the equivalent of price crossing the 28 exponential moving average. So it's like killing two birds with one stone in the sense of using the RSI both as a momentum tool. So follow the trend. Again, a very simple technique. We'll be using a 200-day moving average. Let's say take buy signals above a 200-day moving average, sell signals below 200-day moving average. And how will we use as a signal generating mechanism? We'll use the stochastic oscillator, a very simple run-of-the-mill strategy. If the stochastic indicator gives a buy signal, crosses below the 20, it gives a sell above the 80. Again, it's not a fully automated strategy that I would use, but it goes to show you how much difference it can have using these very two simplistic rules by filtering them with the 200-day moving average. So if we use the stochastic alone, 75 trades, 27 winners, 48 losers. So win-loss ratio is 0.72, win percentage 36% for a loss of $32,000. But if we include the trend, then we take 28 trades. Obviously, a lot are getting filtered out, and 20 winners, 8 losers, 1.27 the win-loss ratio, 71% winning percentage, and we go from a $32,000 loss to $46,000 profit. For the first strategy, we had 52% drawdown, the second 52% drawdown, the second 15% drawdown, which means that all our statistics increase just by taking long trades when the market is in uptrend, short trades when it is below. Very simple. So let's go to our third goal. So the first goal was to eliminate large losses. Our second goal is how to try to increase our winning percentage. So our third goal is how to increase our big wins. So how can we increase our big wins? We said we can do it with two ways. Let your profits run. So how can we do running our profits? Again, in order to have a position run, we must, give it time to breathe, use a trailing stop loss, and of course align ourselves with the macro. So look at this in detail. So what can we use as a way to let the market run? You can use, for example, a very simple technique. You use a 10-day 10-bar moving average as a trailing stop loss. So after the buy and the sell signals, we just trail our exit using the 10-day moving average, a short-term moving average. Now, there won't be an issue if someone uses 12, 11, 8, 9. The point is to be trailing your stop. So this is how it looks like. So for example, you get an entry technique, then you use the blue, so the red line is the your filter, your trend filter, the 200 moving average. The blue line is the moving average that we use as a trailing stop. It's not used as an entry technique. And the oscillator at the bottom is when we get our signal. So when we get a signal, an entry signal using the oscillator, then we use the average to range as our stop loss, and then we trail it with a blue line, the 10-bar moving average. So let's see how much does this increase. So as you remember with the initial test, we took take profits 10 days later. Now we try to trail it. So as you can see, by trailing our stop loss, we have a across the board increase in our results. So for example, now profits are $83,000. Previously it was $61,818. So again, we are increasing our profitability. So the benefits are, by using a trailing stop is that we increase our losses. So we increase our wins per trade. So let profits run. The way to do it, we mentioned, is about using a trailing stop, but we can't be using a large trailing stop each and every time. It's not a recommended technique because large moves don't come often. Realistically speaking, most of the time, you're better off taking short-term trades. So booking your profits early. But in order to trail to be in a position to trail our stops, we have to align ourselves with a macro. So how can we align ourselves with the macro? Because once we do that, then there will be a trend, and then we have a better chance of trailing our stop. So use macro analysis. There are many techniques one can use. For example, one can use the commitment of traders report, which shows you what the big traders are doing. Then one can use, of course, intermarket analysis, seasonals, and also sentiment. So we'll be looking at a brief example of all of these. Trading with economic indicators. In this example, we're using the PMI. So the rule is we'll be using the PMI as a filter. How much the PMI Purchase Managers Index, ISM PMI, using the S&P 500 as an example when the PMI is above 50. Again, use a 200. So if we use the and also using the short-term bonds ETF. So with the PMI, the PMI filter is the blue line. And as we can see, there was an across-the-board increase in the results. So this is how it looks like. The trend with the PMI, the PMI is at the bottom. So whenever it is below the 50 line and the market is above the 200-day moving average, we go long. And again, as you can see, aligning ourselves with the macro allows us to take large moves. So what else can we use? Not just macroeconomic indicators, we can also use intermarket indicators. So for example, whenever there is a big relationship between bonds and stocks, so whenever there is we can filter out our S&P 500 trades with the relationship between bonds. So the buy hold in the S&P 500 is the black line. If we use the just the 200-day moving average, it's the obviously that's the red line. And if we use the 200-day filter with short-term bonds, that's the blue line. And although you can see it does the S&P 500, the filter with intermarket strategy, does lag in total performance from the S&P 500, but it has much less drawdown. Another, this is a bit more esoteric, we can use is the dollar index and the 10-year spread. That might be particular interest to FX investors. So that's the 10-year yield spread between US and German bonds. So as you can see, there's a big correlation. We can try to align our trades whenever the interest rate spread is rising. So you can see the correlations between these two, the spread and the dollar index. Now this is the gold and the yield times dollar index. Again, this is a bit more esoteric. So the top chart we have gold, and the bottom chart we have the multiplication of the yields times dollar. It's an artificial market that we can use because both of these have an impact on gold, both long-term interest rates and also, as we know, the dollar, because usually it's inversely correlated. So by creating a synthetic market, we can see the relationships. And again, of course, we can use it as a filter. So we'll not just be purely price-based. So this is how it would look like. The yield dollar, this is the RSI, this is an index we can create, a fundamental index. Oh, another way to, and the thing is, as you can see, when we align ourselves with the fundamentals in this particular example, the intermarkets, we have larger moves, and that's on the basis of that we can start using a trailing stop. And another way to increase our holding time for trades, so we can have big winning trades, is the commitment of traders report. So at the bottom panel we have the commitment of traders data, and that is basically each week the CFTC, the regulatory authority for the futures markets in the US, discloses what the big traders, the large traders as it's called, are having as a positions both long and short. And this is categorized as large traders, for example, funds and banks. These are speculators, or also commercials. Commercials are traders that have an interest or have a business around either sellers or producers or consumers of a particular commodity. So, for example, if someone is, now that we see, cocoa being on the rise, a consumer of cocoa would be, for example, Cadbury's. And when Cadbury's participates in the futures markets in order to get the product to produce its the chocolates and the other products it has, then it goes and hedges. Or you can have other large commercial companies, for example, in the energy, you can have producers, for example, all drilling companies, or you can have consumers, for example, an airline company. So all these big players that participate in the futures markets in order to hedge, not to speculate, the CFTC aggregates these positions and discloses them, not individually, but collectively. So each means, you can call it basically legal insider information. So these positions are, when aggregated, they are disclosed. And as you can see on this chart, this red line represents the total positions in terms of thousands of contracts. And what I've done is I've highlighted in green vertical lines the extreme positions when large commercial traders have, and I haven't shown what the underlying market is, which is gold. So let's try to see what happens when these, as you can see, when these are large traders, speculators. So as you can see, when large speculators have a huge position, the market tops, where they have very they're increasingly short, they have the market bottoms. So as you can see, there is a very, very big correlation, not always, but a lot of the times the market correlates what the funds are doing. In this particular example, you can see that when they take position, it really does move the market. This is not theoretical. This is not trendlines. These are traders that have thousands of contracts in the market. So by aligning ourselves with these traders, then we can simply try to have the positions longer. This is the bottom chart is a chart of the bottom panel is a chart of the commercials, but it's flipped upside down. That's why it goes with price. So, and then we can create an COT index of it. And as you can see, this creates buy and sell areas. It's not fully automated, but you can create buy and sell areas. We can be looking to start looking for signals. But as you can see, major moves start because of it. Major moves. So these are the methods we can use. So aligning ourselves with the macro and also trailing stops. So in order to avoid losing big, we can cut our losses by having stops, small position size, and of course the portfolio risk management. Increase winning small wins, aligning ourselves with the trend. And how can we win big? By using trailing stops and also trying to look for macro trends. And finally, our fourth goal is not to put all our eggs in one basket. So use different strategies, different time frames, and different markets. So as the Greek philosopher Heraclitus said, there is nothing permanent except change, because markets change, strategies change. So we must use a diverse basket of strategies. So as I mentioned, diversification, you can have system diversification. Have many different strategies. Time frame, have say the same one on different time frames, one on the weekly, one on the daily, one on the hourly chart, and then market diversification. For example, have the same strategy across markets. It may not work equally well. What you'll find if strategies that you apply across markets, they won't work equally well, but it does give you diversification most of the times. So again, multiple strategies, multiple time frames, and using across assets. So this is basically what we're trying to do by having portfolio diversification. So these dashed lines is when one zigs and the other one zags. So it gives you an overall smoother equity curve. This is the effect of diversification if properly diversified. So again, this is a simple system, the RSI system. When the market is above the 100-day moving average, the RSI 14 is below the 25, exit when the RSI gets above 75. Again, I will be using this on my own. We can apply it across different futures markets. These are the results. And as we can see, the portfolio is much better than the individual markets themselves. Again, you can use a Bollinger Band system. Again, 200-day moving average is a filter. When the market crosses the 220 upper Bollinger Band, exit at the 20 bar moving average. Again, as we can see, the portfolio level, it's much better than basically breakout strategy than each individual market themselves. So that's one of the, especially when it comes to trend following, diversification is really important. Again, market strategy diversification. Again, both systems across markets. As you can see, again, the portfolio level is much better than each individual market on its own. So 4 principles of trading. First of all, frequent wins. So how can we have more frequent wins is to buy above the 200-day moving average and short below the 200-day moving average. Now that I think it's a rule that we can have by and large. It can be very useful. There can be exceptions to this, but especially for someone that is just starting out, it is much better to respect the trend. Small losses, use an ATR based stop. Again, there are more advanced techniques, but this is the a good starting point. Also use the risk management pyramid. Large wins, use a trailing stop loss and filter with fundamentals. So again, and don't put all our eggs in one basket. Diversify, diversify, diversify. So again, so we're trying to increase our winning percentage with the trend, eliminate our big losses, which is the most important thing, and also trying to, while we'll be offsetting the small wins with the small losses, to have a good number of large wins, which will provide a good return for the overall portfolio. And so where to from here? As I mentioned, the attendance bonuses, the awarded paper, the indicators, and the advanced webinars to anyone who sends me an email. And with that, if there are any questions, I would like to thank you all for having been here, a wonderful audience, and also have a big thank you to all the people at the at FX Street, and because they do a great work, and I'm really happy, privileged to be providing content and educational content for everyone. So unless there is any other question, I would like to thank you all very much. And I'll be seeing you again next week. Thank you very much. Have a lovely day.